Hello students, welcome to the part second of chapter 9, that is business finance. In the last chapter we had discussed about the investment decision, finance decision and dividend decision. So in this session we are going to learn about financial planning. Now financial planning is very important for the preparation of a financial blueprint of any organization's future operations. And the major objective of these financial planning is to ensure that enough funds are available at the right time. And financial planning strives to achieve the following objective. Number one, to ensure availability of funds whenever these are required. And secondly, to see that the firm does not raise resources unnecessarily, which means that funds which how much ever are required should be readily available and they should not be wasted. So there should be optimum or maximum utilization of those resources. Now when we talk about the capital structure refers to the mix between the owner and borrowed funds. And capital structure of business affects both the profitability and financial risk, because a capital structure will be said to be optimal when the proportion of debt and equity is such that it results in an increase in the value of equity share. So that is why we have, under capital structure we can have fixed capital also and working capital also. So which are the factors that affect the choice of capital structure? Those are cash flow position, interest coverage ratio, debt service coverage ratio, return on investment, tax rate, and cost of equity. There are also other things like floating cost, risk, flexibility, the control, stock market conditions, and capital structure of other companies, which would affect the capital structure. Now, as I said that it would have fixed and working capital, every business needs to fund to finance its assets and activities. An investment is required to be made in fixed assets and current assets. Now, fixed assets are those which remains in the business for more than 1 year, usually for much longer. Like let's say plant and machineries, furniture, land, buildings, vehicles, etc. These are the fixed assets or fixed working capital, fixed capital. So decision to invest in such fixed asset must be taken very carefully, as the investment is usually quite large, because whenever company is investing into fixed capital like machines, land, buildings, equipments, it requires huge money or finance. So decision once taken in this are irrevocable except at a huge loss. And such decisions are called capital budgeting decision. Now, current assets are those assets which in the normal routine of business gets converted into cash or equivalent to cash. Like say for example, inventories, debtors, bills receivable, etc. So how do we manage this fixed capital? Fixed capital refers to investment into the long run, and these are the decisions, or these decisions are called investment decisions or capital budgeting decision, and it affects the growth and profitability and the risk of business in the long run. Now, it must be financed through long-term sources of capital. So, fixed capital are usually financed through long-term sources like equity and preference shares or debentures. And these fixed assets should never be financed through short-term sources. So we can say that investment in assets would also include expenditure on acquisition, expansion, modernization, and their replacement. These decisions include the purchase of land, buildings, machinery, launching a new product, or investing in advanced technique of the production. These are certain factors that would affect the requirement of fixed capital. That is, firstly, its nature of business, the kind of business, whether it is a small scale or a large scale. So, scale of operations, nature of business, and choice of technique. Whether are we using labor intensive technique or capital intensive technique. And also the technology upgradation, whether the firm is continuously upgrading the technology so that they can increase the production by investing into advanced technology or advanced fixed assets or not. Growth prospects and diversification would also affect the requirement of fixed capital. If the company is planning to expand its production, or if the company is planning to expand its company into various other cities and branches, then of course they would require more of a fixed capital. Similarly, when there is diversification into products, or they are planning to jump into different line of production or different products, then again that this factor is also going to affect the requirement for fixed capital. Financing alternatives and level of collaboration are the another factors. So let's understand now about working capital. So we know what are the fixed capital. Apart from the investment in fixed asset, every organization needs to invest into current assets also. Now these investment facilitate smooth day-to-day operations of business. So all the expenses which are required in day-to-day working of the business are working capital or current assets. And they are usually more liquid but contribute less to the profit than fixed assets. We can take these example of current assets in order of their liquidity. That is the cash in hand or cash at bank, marketable securities, bills receivable, debtors, finished good inventory, work in progress, raw materials, and prepaid expenses. Now, these are the factors which are going to affect the working capital requirement. Firstly, nature and scale of operation. At what kind of business are you into? If it's a long term and if it is a large scale organization, the working capital requirement would be more. And also the business cycle and seasonal factors would also affect the working capital. If the business cycle is fluctuating, they would require more capital. There are also certain seasonal factors which would either increase or decrease the requirement for working capital depending on the demand. So production cycle, credit allowed or credit availed, operating efficiency, and the availability of raw materials. Growth prospect, level of competition, and inflation. Now, these are all the factors which would affect the working capital requirements to any organization. So, if the level of competition in the market is more, then the organization needs to invest more into working capital so that they can compete with their competitors. Thank you.